Hey everybody, it's David Duplessis here with Motto Mortgage Sale Home, and I'm here to talk to you today about conventional loans. Conventional is the most common type of loan, so we want to give you some information about it, and we have some variances too that could potentially save some deals for you. So we want to get right to it. What we're going to talk about today, again, the conventional mortgage compared to like FHA, VA, USDA, the eligibility requirements. We're going to talk about HomeReady, HomePossible briefly, and we're also going to talk about asset depletion. So if you've never heard about that, that's a good one, and that could save some deals for you if you have some debt to income ratios. So let's jump right in. What's a conventional mortgage? Well, a conventional mortgage is a loan that's not insured by the government. Instead, it's insured by private investors, basically private companies that will fund those mortgages and then sell them to the secondary market in the form of mortgage-backed security bonds. So they're the most common type of mortgage. And eligibility varies by lender. When I say by lender, I mean that private investor. They're the ones that set the guidelines for conventional mortgages. So we're talking about Fannie Mae and Freddie Mac. Those are the two investors that, again, set those guidelines. They're relatively the same, but they do each have some different nuances, and the guidelines vary just slightly. So we'll actually talk about that a little bit later on as well. They typically both require a FICO score of at least 620. Um, Again, whenever we go over these guidelines, there are also some exceptions to everything, really. So with compensating factors, potentially it could be lower, and we can go from there. So down payments are generally 3%, 5% is the most common. And then you could put as much as you want down. When you get to 20% down, then you can avoid mortgage insurance. So the loan amount, they have a max loan amount of $806,500. That's the ceiling. We're looking at anything above that. They have some intermediate jumbo loans called a super conforming loan. This is also called a conforming loan, same as conventional. And then there's jumbo loans above that. Debt to income ratios around 35-45. Debt to income ratios. 35 is that housing payment, your PITI, principal, interest, taxes, insurance, and condo fee if applicable. And then 45 is the total overall debt that you have. So we're looking at eligibility and requirements. We talked a little bit about that. We're looking at FICO scores, debt to income ratios, down payments. Let's dive right into the conventional variations. We're looking at, again, that conventional loan is what most people take. If you meet certain guidelines, there are some other options that are available for you. For first-time home buyers, and potentially you don't have to be a first-time home buyer, but this comes in a lot with them. We have HomePossible and HomeReady, and also Asset Depletion. So HomeReady and HomePossible, one is for Fannie Mae and one's for Freddie Mac. So they're essentially low down payment programs. They both have income limits on them. And the eligibility depends on the income limit in each town and county that you live in. So every property that we look up, we need to pull up that income limit for that property and see if what the income limits are, and then we compare that to the borrower's income. But you can put as little as 3% down for these. FICO's around 620 or higher. The higher, the better. The higher your FICO score, the better your interest rate's going to be. They offer lower rates. And when I say lower rates, the rates are comparable to a conventional 5% down or 20% down mortgage. But the HomeReady and HomePossible, you can waive the LLPAs. Those are loan level pricing adjusters. And those are different adjusters to the rate based on FICO score, down payment, items like that. So they can waive up to 1.5 on that. So you could actually save 1.5 in points and adjusters and essentially give yourself a lower interest rate there. So it also compares very well with New Hampshire housing. We're not going to talk a lot about New Hampshire housing. That's kind of a product on its own. But we do have some upcoming seminars on that as well. But it's a good first-time home buyer program. So keep that in mind. The next is asset depletion. So asset depletion is when a borrower can use their liquid assets, and not as after they use that money for a down payment and closing costs, whatever they have left, if it's a large, significant amount, we can go ahead and take those liquid assets as long as they qualify for the program. And we can divide it by either 360 months, the term of a 30-year loan for a Freddie Mac loan, or Fannie Mae is actually 240 months. And we can use that amount as monthly income to qualify. So if someone had 360,000 divided by 36 is $1,000, we could use an extra $1,000 a month for extra income. So someone could theoretically not have a job at all. And if they've got, 3 or 4 million in their account, then we can divide that by either 360, 240, and use that money as extra income. So if someone's a little tight on their ratios, but they have some money in an account, we can keep that in mind and use that. And if they don't have any job at all, we can go ahead and use that. So there are some guidelines on that. The max loan to value is 80%. So you have to put at least 20% down. Mortgage insurance companies don't like that as much. But between 70 80%, you need a FICO score of 720. But if you're going to put more than 30% down, then you can go down to 680. So they do have a bottom tier there of 680 for a FICO score. Reserves may be required. You're generally going to have reserves in this program, but those come into play when you have multiple properties. You might have a large amount of reserves required with other investment properties, things like that. But that's all case by case scenario. So that's asset depletion in a nutshell. So as a recap, we've got a conventional loans backed by private lenders. Really, it's Fannie Mae and Freddie Mac. They're private investors. They were actually taken over and kind of monitored by the federal government. So they're kind of government agencies, but they're kind of not. Down payments, at least 3% down. And you can put as much as you want down, at least 20% if you want to get rid of that dreaded mortgage insurance. And then the rates are better with better credit. And we also, if you have first-time home buyer programs, we have some different scenarios we can tailor to that as well. You have to comply with the Fannie and Freddie guidelines. They're the ones that set the rules for those guidelines. And when we run a loan, we actually run it through their automated underwriting engines, and they actually give us an automated approval once we get all the information in the system and run it. So it's nice and quick. They're low to median income programs, and they do have some income limits and geographical limits. So we have to keep that in mind when we're setting up and offering these products. So if you have any questions, definitely give me a call, David Duplessis at Model Mortgage Sale Home. Give myself and my team a call, and we'll get your borrower approved and ready to go. All right. Thank you, and have a great day.